All right, welcome back to another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. I am redoing the show that I did last week. Tim Best is still traveling, but I was so rudely interrupted by the smoke alarms in my house. They had went off, and then I reset them, and then they decided to go off again during the middle of the live stream last week. So I'm going to start this one over and start fresh, and hopefully this one is uninterrupted. So this week, again, we're talking about how IRR and equity multiple is no longer what investors are chasing. Tim and I have raised about $65 million over the last couple of years buying multifamily properties in North South Carolina, Georgia, Mississippi, and Alabama. And, in 2021, 2022, everyone was investing for equity multiples and IRR, right? So if you're not aware, IRR is the internal rate of return, and it accounts for the time value of money, right? So it is your equity multiple, but it has a component of when you receive the money. And for easy math, or not for easy math, but for an easy illustration, a property that has a very high IRR means it starts paying you distributions or dividends pretty quickly after acquisition, right? So if you look at it like a scale, you start receiving money pretty quickly, right? As soon as you close the deal. And then when you sell the property, you get, another chunk of money. So if you receive the bulk of your money at the beginning of the deal, you're going to have a very, very, very high IRR. If you receive the bulk of your money at the end of the deal, you're going to have a much lower IRR. What changes that calculation and how that number goes up and down is when you receive the money, right? So if you have a deal that, let's say hypothetically, you have two deals, and one deal pays you no distributions for 5 years, but when you sell it in 5 years, you double your money, right? That's a 2x equity multiple. I don't actually know what the IRR comes out in that equation, but what I can tell you is that for illustration purposes, let's call it a 13% or 14% IRR. Because you didn't receive any money for 5 years, but then you received a huge lump sum at the very end. If you compare that to a deal that has the same metrics, that you're going to sell the deal in 5 years, and you're going to double your money in 5 years, but you start receiving quarterly distributions from day one, you're going to have a much higher IRR because you've received that cash back and you've had it back in your pocket for a longer period of time, which drives your IRR up, right? That was what investors were chasing. They wanted high IRR numbers. I want to deploy capital. I want to get it back as fast as possible. And then I want to redeploy it into another deal, right? Kind of start leapfrogging deals. And myself included, like I invested a ton of money in the equity side of all of our deals. And a lot of these deals did not come to fruition the way that we thought they were going to because of what happened in the market over the last 2 years. I mean, there has been a great reset in property values. Multifamily values are down 20, 30% pretty easily at this point in time. And I hope we're near the bottom of whatever's happening. But according to the Fed, rates, they're now expecting 3 rate hikes over the next 3 meetings, right? So they're expecting 25 basis point increases over the next couple of meetings, and then no decreases and no increases in 2027. And maybe we start to see some Fed rate reductions in 2028. Now, I know that multifamily lending is tied to the treasuries. So we pay attention to the 5-year and the 10-year treasury bills in order to predict, where our interest rates are going to be, because the way that the bank borrows the money, they borrow it at the 5 or 10-year treasury, or even the 2 or 7-year treasury, depending on the loan that you get. And then there's a margin or spread on top of that, which is the bank's profit. And that's ultimately what your interest rate is, right? So you have the treasury plus your spread, and voila, there you go. You got your interest rate. But yeah, so we think that rates are going to stay higher for longer. We've been saying it for, maybe like 6 months now. What I really need to do is go back through some of these recordings that we have and look at when Tim and I started talking about was like, I don't really think interest rates are really going to come down much further with inflation and jobs and, everything that's going on in Iran and oil prices. I mean, you could go on and on and on. So why investors were chasing IRR and equity multiple, and why so many sponsors were able to meet those metrics, was because they had the the tailwinds of the market behind them, right? So we had cap rate compression, we had cheap debt, we had astronomical rent growth because of inflation, right? So like when the Fed dropped the rate to basically zero and they were printing money like it's cool, you have to know that the inflation went up, right? The value of the dollar went down. So therefore, everything went up. Income went up, expenses went up, debt was cheap, cap rates were compressed because you could borrow money pretty cheaply and leverage the bank debt in order to purchase an asset. And for most people, they were able to just buy a property and sit on it for a couple of years, maybe 2 years or even 3, and turn around and sell it and make, double their money because they got in at a good time. Um, I'm not going to lie and tell you that we didn't buy some deals and underwrite them and assume that we too were going to be able to exit deals in 2 to 3 years. There are some deals that we have right now that instead of being able to sell them, we had to refinance them, and that's okay too. I'm sorry that the underwriting changed and the projections changed, but a lot of things in the market that we can't control also changed. So we control the controllables, and we have to kind of ride out the storm on the uncontrollables. But what I can tell you is, we refinanced 8 properties in the last 6 months or so, 6, 7 months or so, and with inflation coming back and the Fed increasing the rates, that's going to put pressure on upward rents, right? Because of inflation continuing to rise. So when rates do start to eventually come back down and we start to see some cap rate decompression, or sorry, some cap rate compression, we are going to be in a really good position to sell a lot of these assets because the rents are very high, the income is very high, and as the cap rates decompress, the value is going to go up a lot. So right now we're kind of in this weird timing cycle of going up and down, and as long as we continue to focus on paying down our debt and keeping our cash reserves high and making sure that we take care of our properties and our assets, when we pick our heads up around 2030, and we expect the market to be in a completely different cycle at that point, we're going to do okay. And that's it is what it is, right? At the end of the day. Yeah, so why investors are no longer chasing the IRR and the equity multiple is because of what happened over the last couple of years, right? We had insurance rates double and triple. We had one property down in Alabama. The insurance went from $17,000 a year to $84,000 a year. Astronomical insurance increases that absolutely wiped out property values. So we had the insurances go up, we had tax values reassess. In North Carolina, they're on a 4-year schedule, so every 4 years they reassess. Utility usage rates went up maybe 40-50% over the last 24 months as well. And these are hard costs that we pay for the water and sewer on a lot of our LIHTC properties. And we can't control what the utility company charges us per gallon of water, right? That's what I'm talking about. The usage rate of water went up, per gallon cost of water went up. So all of that goes into affect the NOI of the property and therefore the value of the property. So with a lot of those deals not really producing the equity multiples and the IRRs that we had predicted them to produce, a lot of investors now are coming to us and saying, hey, those equity multiple deals were great when they worked, but they're not really working right now. What do you have that can produce cash flow? Cash flow has been the number one conversation I've had with investors over the last 6 months. Obviously, we're starting to have conversations with investors again, talk about, hey, how are we underwriting deals? What did we learn over the last 18 to 24 months? How are we protecting the downside on the assets to ensure that we protect our investor capital first and foremost? What has been our track record over the last 24 months? Have you lost any deals? Have you lost any investor money? Thankfully, I can sit here and tell you, no, we didn't. A lot of that, pat myself on the back here, as well as Tim Vest. A lot of it came down to us being able to inject capital where needed and prevent capital calls where needed. We did have one capital call, but it was for a good cause, and we're able to save everybody's money, which is great. So we used that tool effectively. I hate to say that we did have to do a capital call, but after we had injected nearly $500,000 of our own money, we were starting to get tapped out. So we had to turn to the investor pool and say, hey, we need some help now. So those are what the conversations look like now. how we're underwriting deals now is it's what is your in-place rent roll today and what is my debt today, and I have an expectation to produce 7 to 8% cash flow within the first year. There can be some level of value add to the deal. Hopefully that's more of a management style value add where we can control the expenses by using our own property management company, where we reduce, our operating costs, right? Because we don't charge markup on a lot of services, right? So that's how we're able to come in and add value to properties that we're looking at now. We're trying to stay away from a lot of the older vintage properties. We've learned that even after you deploy $1 million in capex at these properties, they continue to be capex hungry below the line. And what? How does that impact investors? Well, when you have capex below the line, you're continually pulling money from cash flow, right? Because we're in a stabilized loan product now. We don't have a capex draw to draw down on from a bridge lender, for example, and all of the renovations that must occur at the property to keep the property going comes from the property cash flow. And when you have this constraint on your cash flow, it limits your ability to make distributions to your investors. So now a lot of investors understand, hey, we need to do what we can to take care of the asset and keep it running well and keep the rents going up, in order to counteract any increases in expenses that we have not yet seen. So the conversations are a little different, and and everyone seems very understanding of why the distributions are not turning back on, even though we've refinanced into stabilized debt. And we say, hey, look at all this below the line capex that we continue to have to spend. You're buying a product in the 1970s, 1980s. Appliances continue to go bad, right? Because during your capex value add stage, you didn't replace 100% of your appliances, right? You didn't renovate 100% of your units, right? Because you have some residents who are legacy residents, and they're still in classic units that were never renovated. So there's always capex needs at these older properties that impacts your cash flow. But what you can do now is so what we've started to do now is we're starting to sell off some of the deals that we've stabilized. We can sell them for break even, maybe even make a little bit of money, catch up on investor prefs. And what we're trying to do with that is redeploy the capital in price adjusted expectations of new multifamily assets today, right? So what we're dealing with, what we're battling against right now is when we bought properties in 21, 22, and into 23, we're battling the increases in the expenses that we didn't foresee, right? Those 100%, 200% increases in your equity, or sorry, in your insurance costs, and your operating costs have just gone up astronomically, right? So now when we're buying a property, we're underwriting to the new standard of what we're seeing in the market, right? So for example, we used to underwrite to like $600 a month insurance, in some coastal markets, not coastal markets, but some markets we used to underwrite to 600. Now we're underwriting those insurance costs at 1,000, at 1,200. And when we're making offers on properties, we're making sure that our cash flow, inclusive of those expense increases, meet the investor expectations, right? So the only way that you're able to do that is you have to the prices of the properties need to come down in order to meet those expectations, because your NOI is not what it used to be. So it's been interesting. The conversations with investors have been good. They're very thankful to start. Obviously, if you're watching this, are very appreciative of the understanding, of everything that we've been through. Most investors are very understanding of what we did in order to make sure that the investor capital was safe, right? Doing that first and foremost was absolutely paramount. The conversations were hard when we stopped doing distributions on a lot of properties, but now that we did stop doing distributions on properties, and all of these stories on social media are starting to come out of investors that lost millions of dollars, and the Brandon Turner thing where he lost $15 million of investor equity. Let me tell you guys, he is not the only one. There are so many people that I know that have lost deals entirely, wiped out investor equity 100%. But because they're not big name social media influencers like Brandon Turner, nobody's really hearing about it. I've had multiple conversations with people who have been doing this real estate syndication business longer than what I have been doing. And they're calling me, asking me for a job because they had to, break out their W or their resume again and go find another W-2 job. I mean, I can't even count it on two hands how many conversations I've had with people doing that, right? The deals are starting to lose money. They're selling it because they can't refinance it. They're selling it because they're going to try to return some of the investor cash. And now they're trying to go out and buy new deals and nobody's raising money anymore. And they can't survive if they're not making money. So they're wrapping up and they're going to get a W-2 job again. Um, so very grateful to be able to weather the storm and still be standing here today. I mean, we still have a very strong portfolio and we're, repositioning into all stabilized loans. So we're good for the next 5 years now, as long as we don't see some, 200% insurance increases again. But I really can't predict something like that happening again. I feel like, we're starting to see some insurance reductions actually right now, which is fantastic. So, we saw a 30% reduction last year, and we're also, expecting maybe a 10 or 15% reduction this year based on the conversations I've been having with our insurance broker. But nonetheless, we're investing for cash flow, right? All of the investors that I'm talking with now, they're like, hey, equity's great, depreciation's great, but I really want to invest for cash flow. And I had a conversation yesterday with a broker via email, and they were asking like $22 million for this deal. And I really like the deal and I like its location. But at the end of the day, I even shared my underwriting file and my assumptions, my P&L, my investor expectations. I shared all of that information with the broker and I was like, I know they want 22 million, but I'm at like 18. And he's like, that's really low compared to where they want. And I was like, here are the screenshots of my underwriting. Please tell me what I am drastically missing on this deal. Like, please help me understand what I'm not underwriting correctly on this deal. And after I sent him the screenshot, he was like, your assumptions are reasonable. Your price per door exits are reasonable. Your cash flow expectations are reasonable. Your cap rate is reasonable. Um, your pro forma rents are reasonable. And he was like, I think what it is the seller just is unreasonable in the expectation of what they want to receive. And that right there is why we haven't bought a deal in 2 years, right? We are investing for cash flow. We're underwriting for cash flow. And I am not going to buy a deal that doesn't make cash flow now, because the cash flow is the lifeblood of your property. And if you have cash flow, you can survive to live another day. You can survive to pay your debt. You can survive to pay your expenses. You can keep the property running for over a long period of time. And let's not forget that real estate as a whole is a long-term investment vehicle, right? It's a long-term wealth generating investment vehicle that has tax benefits and cash flow benefits. All of it is important, and we need to make sure that we're taking into consideration all aspects of the deal, right? So cash flow is what all the investors want now, because that helps them pay the bills. And what I have learned in raising, I didn't raise the full 65 million, but we have raised a significant amount of cash. What I have learned in all of my conversations with investors is their buy box, right, or their investor box is much tighter than they think it is, right? Everyone wants the shiny new car, but nobody wants to pay the shiny new car price tag, right? So everyone wants the equity multiples. They want to make money fast. They want the high IRR. But what comes with that high IRR is very high risk. And what those investors thought that they were okay with investing in risky deals, they're not. They want safe, stable, predictable cash flow. And I've had more conversations with investors saying, "Hey, you know what? Maybe being in these Class B equity positions, they're not for you. Maybe being into a Class A position is better for you," right? So we structure our deals. We do Class A, Class B. Class A is 0% equity, right? It's preferred returns only, but they're paid first in the waterfall after the bank. And then our Class B investors participate in the equity. The pref is lower, but the overall return is generally predicted to be higher because they're part of the equity of the deal. Um, but what I have learned is, furthermore, that some investors don't even want those Class A returns. They want to be in debt positions, right? And debt positions, first or second lien positions, those are going to be your most secure, least risky investment options. And likewise, they're also going to have the lowest cash flow. They're always going to have the lowest level of return, but it's more safe, it's more predictable. And more people that thought that they wanted to be part of the equity or even part of the Class A shares are saying, I want to be part of the debt because the debt always gets paid. And that is one thing that we have learned, over the last 2 years is the bank always gets paid. So, a little tidbit here. We are partnering up with a very, very well-known operator in our market that operates a debt fund. So we're going to be able to provide that investment option to our investors if they want to participate in a debt fund. The returns are much lower, but the security and the cash flow certainty is much, much, much higher, right? So, little forecast into the future. Tim and Tim and Vive Equity, we're going to be partnering with a debt fund, raising some money for their debt fund, and they have the operational excellence in deploying that money in first lien positions. We are also going to be doing our own deals where we have our Class A and Class B equity shares, where you can, if you want a little bit more risk and a little higher return, you can select those options as well. But ultimately, we hear what the investors are asking for, and we are working within our network in order to provide those options, right? So we're going to have those options for cash flow, for equity multiple, for IRR, for depreciation or no depreciation. In having options for investors is important. So yeah. Sorry, I got some notes over here of things I want to make sure that we talked about how we're underwriting, how, why we're focused on cash flow. One of the things that we're underwriting to and making sure that we have is in place DSCR. We bought a ton of property with bridge loans over the last couple of years, and they served their purpose. We got the deals, we renovated them, we got the values up, we refinanced them. Albeit the values had been reduced quite a bit because of the expense increases, we were still able to trade out the first position debt and do, what we had expected. Unfortunately, not as much cash out at the refinance as we predicted, though, too. So, a lot more of the deals that we're looking at now are being bought with 5-year stabilized loans. We're making sure that our in-place DSCR is a 125 coverage. It has to be per the bank, requirement. So, those conversations with sellers and with brokers are much easier to have because it's like, hey, here's my underwriting, here's what the bank requires, and this is what the price needs to be in order to meet those requirements. So I'm sorry if you don't like my offer price, but this is what the debt can bear, and real estate as a whole is controlled and guided by the cost of your debt. So conversations look different in today's market with lenders and with brokers and sellers, and we're trying to make sure that we have that at least a 125 debt coverage ratio going in day one. Let me also preface this with a 125 debt coverage ratio is not a lot of money. A 125 debt coverage ratio is not a lot of spread. To make that easy, if your property makes $125,000 of NOI, it can support a total debt service payment of principal and interest of $100,000 a year. So you're paying $100,000 a year to the bank. You're bringing in $125,000, so you have a $25,000 spread per year in order to cover any capex, any repairs, any turns. If you have delinquency and bad debt and evictions you have to file, all of that comes out of that $25,000 margin, right? So having a 125 debt coverage ratio is the lowest level of coverage that you can have to qualify. But that's not the ideal coverage. Like, ideally you're at a 120, you're at a 1.5 debt coverage ratio or better, right? Because then you have significant amount of cash flow to cover delinquency expenses, increases in taxes and insurance. You can weather those storms and you can weather those hits because you have the debt flow, you have the debt coverage to cover those expenses if they go up, right? Because your debt will be fixed, hopefully, and your expenses can be variable. How your operations run is going to be variable, and you want to make sure that you try to predict as to the best of your ability, how much you're going to realize in actual net cash flow, and not overstate that in any way, shape, or form. Um, yeah, I mean, ultimately, that's kind of where the mindset is right now. Like, why IRR and equity multiple worked over the last 5 years, why it doesn't really work anymore, and why so many investors are focused on cash flow now more than anything, myself included. I have a ton of investments on the equity side of things, and I myself am looking for more cash flow investments. So basically, I'm underwriting deals to what I would like to buy for myself. And surprisingly, a lot of investors that I work with, they are in agreement of, hey, I want that too, right? So it makes the conversations easier, especially when you've invested your own money into the deals as well. One of the things that we hear about from a lot of investors why they like to work with Tim and I is they're investing with owner operators. There are too many people in this space that are just capital raisers, or they're owner operators, but they use third party management. So they kind of delegate it to everybody else instead of taking ownership of it. But with Tim and I, we're vertically integrated. We run the property management company, we run the equity company, we do the acquisitions, we do the dispositions, we handle the day-to-day operations with the management company. I mean, obviously, we do have a team in place with a director and regional managers and all that other kind of stuff. But ultimately, the buck stops with us. And we intimately know what is going on with each one of our properties because we're so involved with the actual day to day process. That makes investors feel so much more comfortable investing with us. Not to mention, we also invest our own money. We have family money in these deals. My parents, my grandparents, my brother, a ton of family members invest in our deals. So they know that we are doing everything possible to make sure that these deals are successful, that they're safe, that they will get on distribution schedules as soon as they possibly can. But obviously, as an investor, your first rule of investing is to not lose money, and that's why people trust Tim and I first and foremost, is because they trust us to do whatever possible to not lose their money. Yeah. Ultimately, to wrap this up, the market the market shifted in a big way. We're realizing those shifts now. We're pivoting. We are changing our underwriting. We're changing our offerings to our investors. And the market really got honest with how properties need to be valued. It brought out it. People were buying on pro forma a lot, and that got people in a lot of hot water because sometimes pro forma does not come to fruition. So it's reverting back to a lot of its older kind of acquisition mindset of you're paying for in-place cash flow, and it makes so much sense to do it that way. And it didn't work over the last 5-6 years because when the debt was so cheap, because people were transacting all the time. But now that deals are not transacting as much as they were, you have to focus on the cash flow to make sure you have cash and reserves to weather the increases in expenses, or even the decreases in your rents, which we've seen both. So yeah, I mean, ultimately, hopefully you learned something. Hopefully it gives you a little bit of insight and perspective into how we're viewing deals and how things are looking to us today. And I apologize for not being able to wrap up the show last week with the smoke alarms, but I thought that this was a very important episode. It means a lot to me. I really wanted to do this one, so I'm back here talking about it this week. If you have any questions, please don't hesitate to reach out. Peace.